On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. The situation in the Middle East is moving really quickly, and like any geopolitical event, it is really difficult to anticipate where it will go next. US crude oil surged almost 36% last week after those first US strikes, and that saw it finish last week over $90 a barrel. That was the highest that we'd seen since 2023 and the biggest weekly gain in the history of the WTI oil futures contract, which goes back to 1983. So we haven't seen a weekly move that big in decades. Now, at the beginning of this week, prices jumped again, hitting that psychological level of US $100 a barrel. So brace yourself if you're heading down to the gas station to fill up the car anytime soon. That is the highest we've seen since 2022, and that was back when the Russia-Ukraine war started. And before that, you've got to go back to the Arab Spring period in the early 2010s to find the last time we saw oil at $100 a barrel. Now, the Strait of Hormuz is the biggest concern at the moment. 20% of global oil ships move through this choke point, and it's closed. Not officially, but it's essentially closed because insurance companies have cancelled their policies and there's a really high likelihood of attacks. And what that means is that fuel can't get to its destination. So this has also seen production cut back in places because, of course, there's no point producing something if you don't know if you can ship it reliably to your customers. So you've got that choke point and that disruption in terms of getting the fuel from A to B to C. Plus, you've got producers that are simply producing less because of that unreliable transport route. Now, with oil prices at these levels and the challenge that we're all having in predicting when things will ease up in the Middle East, markets are getting nervous. We've seen investors start to think about the impact on inflation, on central bank policy settings, and of course, economic growth. And all of those things impact asset prices, which is why you're seeing a lot of volatility across global share markets and bond markets and a lot of red on the screen. Now, oil prices flow through to just about everything. Oil or fuel is a cost of production for many products and services. That puts pressure on input costs, and those costs often get passed on to consumers, and that creates inflation. That puts central banks in a really awkward position because they've got an obligation to respond to those rising inflation pressures, even when you are seeing some quite obvious downside risks to growth. We've already seen wholesale interest rates rise on the back of all this as investors reconsider the next move from policymakers. Next week will be a fascinating one. We've got three big central bank decisions coming. We've got the Reserve Bank of Australia on Tuesday afternoon. We've got the US Federal Reserve on Thursday morning, New Zealand time. Then we've got the European Central Bank on Thursday evening next week. And markets are starting to wonder what they'll all do. Markets were expecting at least 2 rate cuts from the Fed this year. Now they're thinking, well, maybe it'll only be 1. And when it comes to the ECB, the European Central Bank, they thought they were on hold and they might even have to cut again, but now they've moved to price in at least 1 hike. So that is the impact of those inflation pressures. Across the Tasman, the Reserve Bank of Australia had already been forced to raise interest rates once this year because of that elevated inflation, and now it might have to do more in the months ahead. Here in New Zealand, our Reserve Bank meets in early April, so that is about a month away. And while the OCR is firmly on hold, look, I don't see very much chance at all of any movement at this coming meeting. I really don't envy the communication tightrope that the governor will need to walk. You've got those inflationary pressures, you've got a weaker currency, you've got higher petrol prices, but you've got all the risks to growth. And so that will be a difficult message to talk about without inciting some sort of market reaction. So watch this space there. At least they've got a bit of time to see how things play out and see what some of their peers around the world choose to do and say. Higher fuel costs and potentially tighter monetary policy are headwinds to economic growth, and that is why you're seeing global share markets sell off. The US is holding up better than most, and that makes a lot of sense given its scale, given its strength. Investors always flock to safety during volatile periods, and the US is the world's biggest economy, the world's biggest share market, biggest bond market, got the world's biggest military as well. That also makes a difference. And no matter what you think of it, the US dollar is still the world's reserve currency, so it's attracting some flows as well. Don't forget that the US is also in a strong position in terms of its energy supply as well. It's been a net total energy exporter since 2019. That's looking at all the types of energy that it uses. When you look at oil specifically, it does still import some oil, but imports of oil have been steadily declining for 20 years, and its dependency remains much lower than most. Domestic shale oil production has been healthy in recent years, so they've got their own oil production more so than they've had in the past, and Canada is actually the dominant supplier of imported oil. In contrast, you've got the likes of China, India, and Japan that are big consumers of the oil that is transported through the Strait of Hormuz, making them much more vulnerable to ongoing disruption there. And I think that is why you're seeing share markets like Japan and emerging market shares. China and India are both part of that emerging markets basket. That's why you're seeing a bit more weakness in those places, because those countries at an economic level are potentially more vulnerable to ongoing disruption. So what do we do as investors? Well, I'll be honest, it is really difficult to predict how this one will play out. And that's always the case when it comes to geopolitical events or global tensions like this, especially when you've got parts of the world like the Middle East that are unpredictable, when you've got leaders like Mr. Trump who are equally unpredictable. So it's really hard to say. But what I would say is that panicking and selling everything now is probably not the answer. You could do that, but the risk that you run is that if we do see the conflict subside and you see a rebound, and if that happens, it could be a very sharp rebound, I suspect, you will miss out on that. So as always, it's risky to be all in and very highly exposed to the highest growth assets and the highest risk assets, but it's also equally risky to be completely on the sidelines sitting in cash, because if you're wrong and things do settle down, then you put yourself in a difficult position. So I think the answer is probably in the middle, and it's probably a case of thinking about some of the parts of your portfolio that might be at risk and how you could maybe tilt to some areas that might prove to be a bit more resilient. Always hard to make general statements in that regard because we're all different, and that's why we always suggest that you go and talk to your advisor, or if you haven't got an advisor, good idea to get one, good time to get one, and they will be able to help you make sure that your portfolio and your asset mix is tailored to what you're trying to achieve and the risk profile that you have as an individual or as a couple or as a family or whatever the case may be. But if we think about some of those asset classes that might hold up okay if things worsen, if things remain volatile, I think it'll be the likes of government bonds, high quality fixed income. These will provide predictable income and they should exhibit minimal volatility as long as they're not of a lengthy duration. You know, the 20-year, 30-year bond, they are going to respond a lot to movements in wholesale interest rates or bond yields, and that is going to be a function of inflation expectations and growth expectations and so forth. So here in New Zealand, most investors aren't buying bonds that go out that far. We're looking at bonds of a much lower duration, and I think you're in a safer zone there. Cash is obviously extremely safe. You know, cash is cash. It's not going to go up. It's not going to go down. However, it only makes sense on a short-term basis. Remember that cash offers zero inflation protection. So it's good to hedge your bets, have some liquidity. If you just want to take a bit of risk off the table, have dry powder in case there's some buying opportunities down the track, that's fine. a bit of cash makes sense. But if you've got a 10, 20-year view, then having too much cash is going to do you no favours whatsoever. So, a little bit, a modest amount, whatever suits your needs at the time, but it's not a long-term strategy. Just remember that. Gold, it often performs well during crises or wars. We know that. Energy, defence, commodity exposures, whether they be shares or other types of assets that are tilted towards those sorts of sectors, they'll be benefiting from the backdrop right now. Some companies in the materials and industrial sectors could also benefit, while on the other side of the fence, you look at those that are sensitive to consumer demand, they would suffer if oil prices remain at high levels, because then you'll see ongoing pressure on household income. So those are the sorts of things I would be thinking about, pondering, talking to my advisor about. The situation is highly unpredictable. None of us know where this will go next, at least not with any confidence. And while it is tempting to make drastic changes, history does suggest that geopolitical conflicts often tend to be short-lived disruptions rather than long-term events that completely derail your investment strategy. My best advice would be to simply stay calm, ensure you're well diversified, and instead of making wholesale changes, talk to your advisor about opportunities to tilt your portfolio in a slightly more all-weather direction, or to even take advantage of some of the price movements we've seen lately. That's all for today, team. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.